All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a special edition Christmas Eve live stream with Jonathan Wellum, who is the CEO and founder of Rocklink Investment Partners, Thoughtful Money's endorsed financial advisor up in Canada. Jonathan, how are you?
I'm doing very well, Adam, and looking forward to speaking with you and the listeners.
Thank you. Well, I appreciate you doing this, especially on Christmas Eve. And I believe you are in a warmer and sunnier place than your normal location of Canada, correct?
Yes, so when you're in Canada, you try to get out of Canada, especially during the winter time. So I am over Christmas time. I'm just down in Grand Cayman here. I just have a home down here, so I'm enjoying my time down here, but working and keeping up with the markets. And no slack time here. We have an offshore fund out of Cayman Islands, so I can do a little business also.
Well, all right. Well, that sounds just wonderful. I'm going to apologize in advance, as folks can probably tell from my voice. I am gutting through the flu here. I'm starting day 4, so hopefully I'm counting this may be the day I start turning the corner here. But I've got enough Sudafed NyQuil in my system right now that hopefully I can power through this conversation. But Jonathan, I might be leaning on you a lot here. So I do have some questions for you, and really it's all about looking ahead into the new year. But in addition to my questions, which are going to largely be around what key investment themes you and the team at Rocklink are expecting for 2026, I'd love to let the audience just ask away and ask any questions of you as well here. So why don't we start with that topic, which is okay. So we're really right at the end of 2025 here. The market, I think, has sold off a little bit since it opened this morning, but I believe it hit an all-time high again briefly. We have a bunch of assets at all-time highs. So, Jonathan, as you look to 2026, what do you see? Is it more likely to be more of the same? Will the momentum continue? Or, especially since we've had 3 now back-to-back years of double-digit returns, do you expect some sort of mean reversion to come to play?
Yeah, it's a great question. And we're, as value investors, we typically look at the market from a 3 to 5 year perspective and try to buy businesses that we believe are trading below intrinsic value. And as we've talked about before on your program, the markets are not cheap, so that they are expensive. As you've said, we've seen back-to-back very aggressive years in terms of returns on the market. And so to expect a pullback in the markets and to have weaker markets, I think, is really what people should be thinking about, more than more of the same and seeing another 15, 20% rise next year. That, to me, don't think that's a wise process or a wise way of looking at the market. And so if it does go up 20%, that's fine. That's great. But we want to be protecting ourselves. We want to have some hedges in. We want to make sure we're buying businesses that if the market were to go down quite a bit, we would not go down anywhere near as much as the market, because they're trading at better valuations. And so we're just being careful, cautious, and at the same time trying to find great investments that we can put money to work in for our investors, because our investors don't pay us to just sit in cash. We don't mind carrying 20, 25% cash, maybe maximum. When I say cash, shorter term interest-bearing securities. But any more than that, it's tough, because our investors are paying us to find deals, find places to put money to work.
All right. So when you look towards 2026, where do you see the opportunities right now?
Yeah, so if we were some of the same trends that we have seen over the last number of years, I think, are going to continue to provide some opportunities. It doesn't mean you buy just the leading companies that have done the best in those areas. So the whole AI trend is alive and well. Now, we don't sit and focus on the NVIDIAs of the world. We try to look below the surface and, okay, let's find where we're going to need more base metals. Maybe it's copper assets. We can invest in some of the commodity businesses. Maybe it's physical infrastructure. that we can take advantage of. So companies like Brookfield or Prologis are providing and getting some upside from a lot of the build that's going on. Maybe it's electrical utilities that have to be built out. And so we can buy electrical component businesses like Schneider or Eaton, things like that. So that trend, I think, is alive and well, but you have to just be careful. I don't think you just go and pay anything just because the trend is still continuing to go forward. One of our concerns is that trend can slow down. We can get a second derivative that's negative, and all of a sudden the rate of growth is not going to be the same, and it starts to slow down. That will take some of the stocks down that are highly priced. So that trend is alive and well, but be careful and look below the surface and try to find businesses that are better positioned, trading at much better cash flow multiples, and so you get some protection. I think the rotation, another trend that we're looking at is just, again, more of a rotation in the market. We've had a lot of these high-flying companies, the Mag 7, et cetera, do very well. And everybody's talked about that year after year after year. Well, eventually, there's no question we're going to come to a year and they're not going to perform very well. That's inevitable. We just don't know when that'll be. So try to find some other businesses that have been completely overlooked. Part of the AI trade has put, I think, some of the software companies, people say software businesses will not do as well because of AI. So we own companies like Roper Technologies, which we think, again, continues to grow and do very well, hasn't had any slip up in terms of its opportunities to growth, but the stock's done nothing for 2 years. And so valuations are quite attractive. So we're looking at businesses like that. Some of the manufacturer industrial businesses also have not done that well, and are up maybe 20-25% over the last couple of years. But they're great companies, and they're still continuing to grow. We own a company like Carlisle Companies, which does all of the roofing, flat roofs, all of the industrial buildings across America and a few other countries. And this thing's trading at cheap multiples. So that's another area. Look for businesses in areas that have been overlooked. No one cares about those sectors, and go into those areas. And then, as we've talked about before, I do think, precious metals is an area that you need to be careful. I do see more growth going forward, but it's done exceptionally well. The gold, the silver, the platinum, a lot of the base metals. And so that's an area we continue to invest in, but we want to be careful. We've taken some money off the table on some businesses that have done very well, and continue to rotate and find other businesses that we think will do well that haven't gone up as much as the underlying commodities should reflect in terms of the stock price. So those are some of the areas that we're focusing on in terms of opportunities to invest.
Okay, and worth reminding the audience here that your approach at Rocklink, and correct me if I'm miscategorizing this, but it's very Buffett-esque, where you're not playing trends, you're not buying sector ETFs or things like that. You are doing the old-fashioned kind of gumshoe due diligence work of trying to find underpriced value in companies that you would be excited to own for years, and you're hopefully buying them at entry prices that you feel good about, and then hopefully riding them until they get fully valued by the street.
That's exactly the case. And that's why we'll maybe focus on 20, 25 stocks in a portfolio. And we just a couple of days ago, we were talking to an interesting, like insurance is another area, insurance, property casualty, commercial insurance for businesses. There are a number of insurance companies that are trading at very attractive prices, maybe just a little over book value. Investable assets per share are larger than their stock price. Companies that have, our abilities to generate strong profits year after year with combined ratios way below 90%. So those are opportunities. Again, so what we do is we're constantly looking below the surface and try not to get caught up with just all of the headline news, which is not irrelevant, don't get me wrong, but there's a lot of businesses below the surface that people just haven't really been looking at that much. Maybe they're not in all the index funds, but they're trading at great prices. And overall, as we know, the stock market is a weighing machine over the long term and not just a voting machine. So I think, again, going to 2026, there's opportunities to invest, but again, be careful, not just the ones that have done well over the last 3-4 years, they can't continue to compound at 20% a year. This is just not economically possible. And so investors need to be careful. It doesn't mean they have to run from the market. It just means they have to work harder to find businesses that are trading at much more attractive valuations.
Okay. And, nobody knows exactly what the future brings. So, I'm asking you to guesstimate here a little bit, but we can certainly make an argument that the market is overvalued, maybe dangerously overvalued, largely due to the just nosebleed valuations of the hyperscalers here and their disproportionate percentage of the major indices. You can argue for an approach like yours that says, hey, I'm buying an undervalued asset and I'm going to and hopefully the market will eventually recognize its true value and I'll ride that. You can also say, hey, at a time when the market's really overvalued, it's kind of safer to be buying stocks that have been kind of left behind because they don't have all the froth in them that the rest of the market does. And the reason why I'm sort of contrasting those two is what does your gut tell you 2026 is going to be more of for investors? Is it going to be a year of offense, of trying to find the companies that are going to ride the next slingshot up? Or is it putting your capital in places that will be less impacted if indeed we finally have the bloom come off the rose for the AI mania?
Yeah, I think it's to be very careful, cautious, and to really put your money into businesses you think that will protect your capital. I don't think the top line indexes. Again, we don't know, and we try not to be prognosticate on this too much because and no one knows what the next year is going to bring. But I would, if I were a betting man, I'm an investor. I'm not a betting man, but if I were a betting man, I would bet that the indexes are not up much if we were speaking a year from now. That it's just the law of large numbers, the valuations, the price earnings ratios, the price to cash flow, they're all extended. The other thing I'd point out that we often don't talk about on the programs, but I think it's also important, is that the United States is basically the only country that's driving a lot of economic growth. I mean, I'm in Canada, so when I look at the Canadian situation, I look at just the tremendously poor decisions that are made at the federal government level, also our provinces, similar to your states. We have virtually no economic growth going on in our country. We have high taxations, high regulations, stymieing resource developments. In the United States, again, if I'm speaking mostly to Americans probably watching the program now and in the next number of days, you're in a very unique situation where you have, taxes are coming down next year. You've got capital coming into your country. You've got a government, especially federally, and most of your states that are fast tracking resource projects to get done, and money's flowing into your country. You've thrown out all this DEI nonsense. You've thrown out the exceptional and extreme parts of ESG, the green agenda. This means economic growth. And so I think in the US, you're likely to see greater than 5% growth next year. There's already 4.3%, whatever, just recently. And I'd be shocked if it wasn't more than 5%. Around the world, though, Europe is a mess. I mean, all they're concerned about is restricting free speech and communication of ideas and protecting the governments over there and regulating to death. There's virtually no growth in those countries. The UK is in serious position. So, China, of course, the US is pushing back against them and so on. So I think when you look around the world, global growth is going to be rather anemic outside of the United States. And so even when we're investing, we're continuing to look at companies that have a large US exposure and companies that can profit from much more sane, rational economic policies that are coming out of the US. That doesn't mean they're perfect. The US has a large deficit. It has a $38 trillion debt. There's money, the debts are intractable in one sense, but at least there's the attempt to grow the economies, to expand the economies, to drop prices, to get inflation back in line. And the only way you do that is produce, and shrink the size of government. So that's only happening, I think, in one major country in the world, and that's in the US. The rest of the world is not doing that. And so I think that will constrain economic growth and make equity investors should be careful and cautious.
Okay. So let's dig into this a little bit. So first off, I believe that most other major economies are bumping up their fiscal stimulus now. So to a certain extent, there are people that are thinking, okay, well, then we're actually going to see some growth out of that next year. Sounds like maybe you differ from that.
Well, the problem with some of that growth is, as we all know, is it's going to come just from government spending and more deficits and more debt. And that's, again, why you want to own precious metals for the long haul, even though they've done well. And I think that's one reason why gold and silver have done so well. Palladium also, platinum, I should say, because of the maybe the less green agenda and so on. But that's because people are concerned about fiat currency. I mean, I think it's virtually impossible for our money, including the US dollar, to maintain significant purchasing power over the long term, with the US dollar probably still being the strongest, which means all of the rest of them are worse. And so that's a major issue. So yeah, you got Germany spending more money on military because Trump's put pressure on NATO, and so they're all opening the spigots over there. But that's all debt that will not create true long-term wealth for citizens. It will crowd out private capital. It will drive prices up. It'll drive standards of living down. And that's all we've seen throughout the last couple of decades in the Western world, as standards of living have collapsed with the increasing size of the government and bureaucracy. So what Europe's going to do is just they're going to compound their problems over there. So in the short run, yeah, investors can say, okay, maybe there's going to be some opportunities in some stocks, but longer term, they're basically castrating their economies and truncating wealth creation, which again has created some of the problems. I saw your interview recently with Matt Taibbi, and standards of living for the next generation are horrible. And that's because we haven't been investing in productive assets, and the government is taking over more and more, and the state and the debts have mounted, and the central banks have printed way too much money. And so that's not a recipe for wealth creation. Of course, in the US, again, love Trump or hate him, it doesn't really matter. At least the economic policies ring true to something that's going to get back to some production of goods and services, and trying to bring inflation down as a result of that. That's the only way you're going to bring inflation down. And to deal with wealth levels is to produce. Manufacturing, onshore your manufacturing, onshore a lot of the production that was taken offshore, and that will have longer term effects, positive effects.
Okay. So I want to get to the precious metals in just a moment, based on some comments you made, and that it's been a big focus of your firm for years, and this has been a absolutely phenomenal year for them. But a couple of things. So you expect basically the U.S. to outgrow most of the rest of the world next year, and sounds like for good reasons, right? It'll be more organic, productivity driven growth. And as a person living in the U.S., I hope you're right. I want to just make sure that folks are aware. In theory, the markets and the economy are two different things. And while if one does well, the other usually does well, that does not need to be the case. And I think we've gotten to a point where the market has largely driven the economy a lot recently. And certainly all the CapEx spending on the hyperscalers that has sent their stocks to the moon has also been like the main engine of GDP growth in the U.S. until recently. But it sounds like you think next year, and correct me if I'm misinterpreting this, but that the new administration's policies of trying to spur true domestic productive growth, and this has been things that have been put into the one big beautiful bill, and it's been deregulation, and it's been new trade deals, and it's been Trump getting other countries to promise to bring more manufacturing into the U.S. and other foreign capital into the U.S. All that stuff, you think is going to start actually producing real results. So if that indeed is the case, and we get the 5+% GDP growth you think we might get, which would be amazing, it doesn't necessarily mean that the stock market's going to do all that great. Because I think you said earlier, despite your 5% expectation for GDP, you wouldn't be surprised to have the markets be flat.
That's exactly the case, that often there's a separation between the market performance and the underlying economic performance. And I think it's very important to point that out. And so we have to be cautious. I mean, sometimes the market in the short run will respond better if you're just cutting interest rates, which we could see again next year. I mean, that is what the administration is trying to push for. And the Fed governor that they're trying to put on will probably be a little bit less hawkish on interest rates. That too will also spur on some economic growth in the U.S. But it is important to point out that often there is the market will respond to a socialist government coming in and spending all sorts of money in the short run. But again, I'm looking at things 3 to 5 years. Those short-term benefits, if they're not long-term building wealth and building a capital base in an economy, and you don't have a rational tax structure and a regulatory regime that makes sense, then eventually the stock market will go nowhere. But in the short run, you're quite right. Next year, with all of the right decisions being put into place, which will take some time to work out, this isn't going to radically, you're going to need a number of years for capital to start coming back in the country, for investments to be made. It doesn't change overnight, of course. That's going to take many, many years. But the stock market might look through that and knock the valuations of stocks down in the short run. And we might not see the benefit in the stock market itself, even though on Main Street things will be getting a little bit better, hopefully.
Yeah, and that's also, folks, too, why valuations matter, right?
Mm-hmm.
If valuations, I mean, right now, for a lot of assets, they're at all-time highs, record all-time highs, CAPE ratios, Buffett indicator, all that type of stuff.
Mm-hmm.
And so, when you buy high, you reversion to the mean, whatever, kicks in at some point. And so even if the underlying economy starts growing, you've got to get your valuation down to a more, you're likely to have the valuation metrics come down to much more historical norms, which sometimes you can have a growing economy, but a flat or declining stock market. All right, so there's a comment that one of the folks mentioned here that I'll pull up in just a second. But when Trump was coming into office, I think a lot of people had been pretty shocked that we didn't have the recession that everybody was expecting in 2022. And then 2023 and 2024, the recession didn't arrive, largely because of all the stimulus that was pushed out into the system. When the baton was handed off between Biden and Trump, I think a lot of people thought that, okay, well, we're surely going to have that recession now. And Trump would probably let it happen because he could blame it on Biden and lower his baseline and have a lower point from which to make progress over his 4 years. Didn't happen. And, again, Jonathan, you and I could spend tons of time looking at a lot of recessionary type data. But, like today, we just got the latest initial jobs claims. They were pretty fine. And we can debate the quality of the jobs data and whatnot. But while there's lots of parts of the economy that still seem sluggish, to your point, there's also reason to expect that economic growth could be pretty robust next year. So this user just asked, I think Trump's going to thread the needle. And my question here to you is that what you think? I mean, if you're thinking 5% GDP growth next year, then that would really require us avoiding a recession and going straight into much higher growth, as the president has said was his goal.
He might. I mean, again, we don't know, and we invest in businesses and try to find them, as they said before, that are trading below intrinsic value and all of that sort of stuff, so we can protect ourselves. But if we step out of that for a moment, he might thread the needle. I mean, Besant is pretty adamant that they're going to have heavy, significant growth next year. The other factor I think you have to realize is there's so many moving things going on in the U.S. right now. Immigration has just been cut. You actually have net migration out of the country because people are leaving. Again, but those people leaving are net cost. I mean, yeah, okay, you can hire them at a slightly lower price and things like that. But look at the new jobs in the United States in contrast to what we have up here in Canada, where almost all the jobs are going to people coming into the country, and none of the Canadians that have actually built the country are getting jobs. In the United States, all of the new jobs are going to actually Americans. This is a good thing. So there's so much detox going on, I think, with the bad policies over the last number of years, not just Biden, but really going back a couple of decades. We see this in all of our Western countries. They're trying to stabilize things in the US. And I think that will and might have a very positive impact on the economy, much more so than the typical economists, I think, are seeing. How can you take several million people out of the country? That's going to help on real estate prices going down, rental costs going down, inflation issues should be better off, and because of that. But anytime you can hire your own domestic people and try to cut social welfare and costs in your system, that's a good thing. Look at the abuse that's come out of Minnesota, California. Again, not to pick on you guys, we've got abuse up here in Canada, but you can't run you can't run an economy where you've got literally millions of people just living off the system and taking money. So anytime you can start cleaning up some of this mess, it's going to have positive impact on the economy. So I think that he might thread the needle. Who knows? But I go back to his policies. He's doing the kind of economic policies that will result over time in the production of more goods, more services, more capital being put to work, expensing it quickly so that money can come into the country, and allowing people to make profits and reinvest back in their business. That's what drives an economy. I don't know what economics courses other people have taken, but that's what we all know is going to work over the long term. If you can get interest rates down, also your cost of money, that's just going to feed the situation. So with the new Fed governor coming in next year, and maybe rates coming down a little bit more aggressively than under Jay Powell, that also will give Trump a little bit of wind under the sails. So that could again help him thread the needle. We'll have to see. It's going to be interesting.
Okay. So the reason why I wanted to kind of dig into this is, we've certainly had plenty of guests on this channel over the past year who have been very concerned about where the economy was headed. And we've talked about the K-shaped economy and, the bottom, say 80%, struggling and falling further behind and all that stuff. And so, that can paint a dark picture for 2026, right? Of, okay, well, likely to fall into recession as those consumers just tap out. And, we saw, record bankruptcies this year, or at least bankruptcies at a rate we hadn't seen since the global financial crisis and all that type of stuff. And so it sounds like what you're saying is, yeah, that data's been out there, but be careful if your default assumption is recession and doom and gloom for 2026. At least in the U.S., you see on a net basis room for optimism versus pessimism.
Well, I do in those policies, having those are the kind of policies that do drive economic growth. That you're also going to see a cut in taxes on Social Security. You're going to see no tax on tips coming into place into 2026. Those all help pretty average people, Main Street type of thing. So I think that, interestingly enough, Scott Bessent has talked about this, Trump also. They're trying to, and JD Vance, they're trying to actually reinvigorate Main Street and not Wall Street. Now, if they can pull that off by, again, getting jobs back into the economy, manufacturing, onshoring things, getting capital into more businesses, if they can pull that off and get the standard of living increasing and the cost of housing down, this could be a wonderful thing for the average American, and in terms of their net worth actually going up for once. That did happen under the first 4 years under Trump, as you know. Again, you're trying to reverse this massive expansion of the state, the massive expansion of regulation and taxation, which has just been without end in sight. And along with this attack on the economy through the whole green agenda, and I'm talking about the extreme by environmentalism, which just increase all the costs of production and manufacturing. If you start unwinding all of that, I think it could be incredibly positive. That's my view. Now, it's not easy and it won't be smooth. And the U.S. still has a large deficit, and it has a big accumulated debt, and it's got a lot of underfunded liabilities. So this is an ongoing challenge. And I think that as investors, that's why you balance out your portfolio. You have some diversification, but at the same time, I would not be running for the hills. I'd be looking for investment opportunities.
Okay, great. All right. So, moving on from this then, to precious metals. They have had, Jonathan, you and I have known each other long enough that, we're both folks that kind of bought into the reasons to buy precious metals trade a good long time ago. Your firm has made them a focus area. All that said, I'm going to bet, like me, you didn't expect 2025 was going to be as amazing a year for them as it has been. And so I guess my question to you is let's talk about where you think they're going to go in 2025. But I guess first and foremost, what do you think about where they are right now? Both gold and silver at all-time highs. Silver has just been on an absolute tear. Is this a fundamental repricing? Is this just sort of a new price era for this? Or, as we've seen with these metals in the past, when they have gone up exponentially like this, it's a very finite peak, and then it usually craters by like 2/3 and becomes dead money for years.
Yeah. I firmly believe, and of course I could be wrong, but I firmly believe that it is a repricing of the underlying precious metals. And the reason I say that is because of the massive buildup of debt. So if you look at the gold price, I think it's playing catch up to the expansion of the global debt that's been accumulated over the last number of decades. And that just continues. The money printing that's gone on the last 10 years and then was put through the COVID years. And it's never really gotten anywhere near back to where it was previous to COVID. So we've got this money up there. Now you got the Fed going back and saying it's building up its reserves again, which means it's just printing more money and buying short-term treasuries. So I think it's a repricing because of the massive buildup of debt, which is 3.5 times global GDP. If you look at all of the debt that's been accumulated around the world. And so that's the issue. I think silver picking up this year, silver has just been a laggard. When you compare silver to gold, again, I don't get caught up too much in ratios, but the ratio, when it starts to become 100-1, when the actual production is 8-1, when we've been in deficit on the production of silver, in other words, we're using more silver than what's been produced for the last 5 years. When you put all of that together, I think silver is playing catch up, and the paper markets are not dominating as much as they were. And I think the physical need, the strategic nature of it, the fact that China says they're not going to be exporting out of their country come January 1st. All of these factors are feeding into the demand for silver and the fact that it's been undervalued and has to be repriced in order to produce more of it, so that we can again use it in a lot of our future technologies.
All right. So at Rocklink, then, you've had this phenomenal year. A lot of your precious metals holdings have done very, very well. What are you doing? Are you taking any profits here? Are you just letting it ride? Are you maybe thinking that, okay, it's had a fantastic year this year, probably won't next year, so let's decrease the percentage relative to other sectors we think could do better next year? How are you reacting to this bonanza that we've had in the precious metals this year?
Yeah, and it has been quite a bonanza. And just you had mentioned before about our expectations, and we did think again, we see it trading up higher as for 2025, but not as much as it went up. I mean, you never can. I would never put my finger up in the air and say it's going to go up 70% and silver is going to go up over 100%. That would you just don't build those into your expectations. You want to be very careful with
I think
investing.
silver's like 150% now.
Yeah, because it started around 28, so somewhere around 28. Yeah, so
It hit 72 this morning. I think it's down to 70 something right now, but yeah.
yeah, and I think investors should continue to expect, again, a lot of volatility. So I think you're going to see $100 moves in gold because as a percentage change, of course, it's smaller when you're building off of a $4,500 base. And the same thing with silver. Whenever you've had this extension like this in price, it's going to be even more volatile. That shouldn't throw people off. So longer term, Adam, to answer your question, we want to be in the space because the longer term issues that have been propelling silver and gold have not disappeared. So those are the big macro factors. And even with the U.S. growing at, I think it will grow about 5% next year in terms of the economy, it's still got a massive deficit. And so it's still piling debt on, and adding to its debt pile. And that's one of the stronger countries. And as we already talked about, Europe is going to be, they're opening the spigot and spending more money over there on military and so on. China, who knows what they're doing. Japan's is a debt quagmire and so forth. So all of those reasons mean that we don't really trust paper money. And so we don't trust the paper, the value of it. And so we want to be in precious metals. But right now we've done exceptionally well. So yeah, we've taken some money off of the table, especially if it's someone's weighting gets way too large in terms of their portfolio. We'll pull it back. And we've also tried to redeploy from some of the more highly valued securities, ones that have done really well and are trading at a higher price than net asset value multiple. Then we try to find other businesses that are trading at a lower price to net asset value multiple and have better growth prospects. And we've even gone down in a couple of cases. I spent some time in Switzerland at a precious metals conference, and we've talked to a lot of smaller companies. We've actually added a couple of smaller mining companies that are trading, we believe, at very inexpensive prices so that we can, again, try to get more upside by buying cheaper companies, cheaper valued businesses, but with a lot of upside that are run by incredibly good people and are backed by a lot of billionaires. So we have tried to, again, alter our weightings and reposition some of our stocks just because they've done so well this year in our portfolios, and then add a few smaller ones that we think have tremendous upside opportunities, and the market just doesn't care because it's focused on the larger miners or larger royalty companies.
Okay. And how worried are you about just a pullback in the prices of the metals given how far and how fast they've run of late?
Yeah, I don't know if I'm worried, but we certainly are telling our investors, be cautious, be careful. We can get a step back, and that could create some volatility, and they should expect that, and that will show up in their portfolio numbers. So they get their statements, they go, geez, we're down 5-10% on our overall statement because precious metals might be down 20%. Then that's just the way it is. You can't go up 25. Some of our clients are up 25, 30, 35% this past year. You can't go up that much in 1 year without giving back a little bit. What we just want to be careful that we're not trying to be too super smart when it comes to market timing. Market timing is incredibly difficult, especially if the longer term trend is in place. If the longer term trend wasn't in place, and all of a sudden all the governments around the world were not constraining our free speech, and they were cutting taxes and cutting regulations and balancing budgets, then we'd be out of gold. We'd be out of silver, right? We don't see any of that happening. In fact, on the contrary, we see governments going in the wrong direction, with the exception of a handful of governments. Down El Salvador, you've got a better government. You got Argentina trying to do some better things. Chile just elected a more conservative government. Eastern Europe's got a few governments that make sense. Hungary and so on. But other than these are a handful of governments. Other than that, it's full steam ahead, self-destruction and suicide. So we want to continue to own them. But whenever you go up a lot, it is healthy to clean out the system a bit, and we should expect some pullbacks. If they don't come, fine, but we should expect the pullbacks, and then you can dollar cost average, and you can buy, line up the businesses that you really want to buy. Wait, be patient. If they come off, then you can step up and buy more. So please, for people, if you haven't been in the space, I even had a couple of investors email me this past week saying, "Where can I buy physical gold? I want to buy physical gold." I'm thinking, oh no, maybe we are getting near the top. And you try to tell people, if you haven't even been invested at all in the space, please just dollar cost average, buy high quality, go slow to go fast. Don't just jump in with both feet. You could end up, dropping 20, 25%, and then pull all your money out at the bottom and lock in a loss. That's the way people often operate. You buy high, sell low. No, you want to buy low, and you want a dollar cost average into this if it's an ongoing trend that's going to be there for the next 5 to 10 years.
Okay. And just for those people that may be interested in buying physical gold or physical silver, just a reminder, you can do that at Thoughtful Money's endorsed provider, the folks at Miles Franklin. That's Andy Schechtman's shop. You can go to thoughtfulmoney.com/buygold. He can handle clients both in the US and in Canada. And just a reminder, folks, that while supplies last, and they're still lasting, Andy is offering this audience the exclusive deal of being able to buy junk silver from Miles Franklin for $1 under spot. Andy says he's never seen that, he never had that ability to do that before. So if that's something that's of interest to you, go fill out the very short form there at thoughtfulmoney.com/buygold, and Andy and his team will help you there for that offer or any of your gold and silver buying needs. All right, Jonathan.
And Andy's fantastic. I love the programs you do with Andy, and I follow him and his knowledge of the industry. We use that to help inform us also, and have great respect for Miles Franklin here.
Well, thank you. One of the things I really appreciate about talking to Andy is he really has his finger on the pulse of what's happening with the flow of physical inventory. And obviously, there's been a lot of bottlenecks in the supply system as more and more players have been stepping up and demanding delivery, which I think is a big part of what's been catapulting the silver prices of late. And in some ways, that excites me as a precious metals holder, because it lets me know that, okay, this thing that I own is becoming more scarce. On the other hand, I know that inventory scarcities usually don't last forever. And so one big question mark I do have, which I'll be talking with Andy more going forward from here, is just, hey, if they're able to start, removing some of these supply bottlenecks, does that pose a risk of the price actually dropping materially? I don't know, TBD. We'll see what Andy has to say about it. Could supply get even tighter from here? Absolutely. So it's not something I think is necessarily going to happen tomorrow, but it's a potential risk.
Yes. Well, and I know we've had a slowdown in some of the green agenda. And again, I'm all for environmental control and in terms of looking after the environment, but the extreme agenda was pushing things a little bit at a faster rate with the EVs and so forth. But with the new battery technology and some of the stuff that's coming down the pipe, I mean, the demand for silver is pretty significant. Mm-hmm. These are big numbers. I don't even like to throw out the numbers. They're fairly large, and the deficiencies or the deficit that we go into can become very large quickly in the next number of years. And so it'll be interesting to see if corporations step up and try to hedge themselves and buy into the space. That would not surprise me at all. We certainly are hearing more and more about that. But it's a strategic asset. The Trump government made again silver a strategic asset because it is, and so this days of I think low prices in silver are probably behind us because of just the demand, and it's in producing. It's hard to produce the level of silver that we're using. So.
Yeah, well, I mean, that's for folks like us who've been buying silver for years. That was sort of a trend that we've been seeing coming. And it'll be interesting to see. I mean, we certainly know that silver, in terms of mining output, it's becoming harder and harder to find. Certainly in a pure silver mine, the vast majority of silver that's mined, as you know, Jonathan, is a byproduct of other type of mining, and it's because humans being humans over the past bunch of centuries we went after the easy stuff first, and there's not a lot of easy stuff left when it comes to silver. So, you get sort of dwindling, pure supply in the earth, and then you get increased demand from industry and whatnot. Yeah, I mean, those macro trends are big reasons why I and I think a lot of other people, got into silver in addition to the monetary side of things as well. So we'll see. I kind of just am raising some of these concerns because, Americans being Americans, for some reason, we love to buy things when they're running away in price to the upside, right? And oftentimes you're putting yourself at risk of cooling off or reversion to the mean or whatnot. And I just want to, make sure that folks aren't jumping in, especially if they're first-time precious metals buyers right now, at least not being cognizant of the fact that things are running pretty white hot right now.
Yeah, and I think you start to see all these video clips and blogs and so forth talking about triple-digit silver, and even I even saw one this morning while I was just paging through YouTube. I think it said four-digit silver, and of course people just start salivating then. And we don't know what that's going to go. You have to buy today based upon reasonable economics, and you want to buy at a discount. You don't want to be paying full price, and that's why we tell people, if you haven't been in, just dollar cost average, develop a systematic approach so that if you're buying at 70 and all of a sudden it goes to 50, which it could go to 50, it could go to 50 quickly and then back to 80, and up to 80 and so forth, then you're dollar cost averaging and you're not panicking out. The worst thing is you feel that you're missing out, this fear of missing out. You buy at 71, it goes to 50, you panic out and you go, I'm stupid, I'm locking in my loss, and then you don't go back in again until it's 100. And we see this all of the time, and the only way you can avoid that is you've got to be self-conscious here about what you're doing, and you have to have a disciplined investment process and policies into place. Because even as a professional, I've been investing for 36 years. When that thing, it's a lot easier to buy when something's going up. I'll say the same thing, but then I have to slap myself and say, Jonathan, go back to the principles, back to the numbers, run the spreadsheets, be careful, dollar cost average, wait. You have to do that, or you're going to get your head handed to you.
Yeah. All right. Very well said. All right. Well, look, Jonathan, I'm going to I'll try to grab one or two questions here from the audience. But before we do, is there anything that you and the team at Rocklink are, really focused on for heading into next year that I haven't thought to ask you about already?
I don't think so. I mean, we're constantly looking at different niches, running screens on different sectors, trying to find unique opportunities that are in the marketplace. That's just what we do. I think the larger term trends, a lot of people know what they are. They are major trends. They're not going away, digitization, robotics, AI, all of that. But the issue, I think, is just be careful what you pay and see if you can't find businesses that are below the surface that can also benefit from these longer term trends, but you're paying maybe half, maybe a quarter, even a quarter of the cash flow valuation multiples, and you're getting businesses that are growing very quickly. So just be careful, look below the surface and dollar cost average. The overall indexes are high. They're not cheap. And it's perfectly reasonable if they come off a fair bit in 2026, even if the economies are doing well. And so, again, just be patient, be careful, know what you're buying, know why you're buying it, have the right time horizons. If you need to spend the money in a year or two, please don't be putting it in the stock market. That's for longer term money, at least 3 years, but more like 5 years out. Then you can weather the ups and downs. And sleep well at night. So just, again, these are just very practical things that people need to consider when they're investing.
All right. Jonathan, what do you think about oil and gas, the oil and gas sector right now?
Yeah, I mean, we again, if you go back to these longer term trends also, that require more energy. So if we're going to build even half the data centers that they're talking about, let alone, even if we don't build all of them, even if we build some of them, and we have digitization, robotics, and all of that, we have an increasing demand for energy. And for many years in North America, energy demand was kind of flat, even though we were growing our GDP just because of efficiencies, and we were driving productivity, using our energy more effectively. But to have energy growing at 3 to 4% a year overall, those are large numbers that compound. So I think the oil and gas sector is an area for opportunities. We do have some investments in that space. I didn't mention it, so you're quite right. We do have some even in some of the pipeline business. We have some in Enbridge, some in TC Energy, which is the old TransCanada. They got rid of the Canada name because most of it's in the U.S. But we have some Suncor. Exxon's another one that's just boring, but it's big. It's got low cost of capital. It's got a big dividend. They got their religion back and focused on fossil fuels instead of getting in a whole bunch of other areas. We have companies like CNQ, Canadian Natural. So yes, the valuations in the energy space are quite cheap. Cash flow multiples are quite low, and we're going to need fossil fuels from here through our lifetimes and more. So I think this idea that fossil fuels are antiquated, they're going to go away, is crazy, especially natural gas, which is going to be very important to power a lot of these data centers. So we focus a little bit more on some of our Canadian companies up here. They're pretty cheap, but there's a number in the U.S. So I would encourage investors also, don't overlook the space. It is cheap. It is inexpensive. It's sort of been out of favor. And but again, the cost, the drop off in terms of production in some of the fracking areas, I think will keep the price up, probably the 50s and 60s. And so find companies that can make money, good free cash flow at $55 a barrel. And I think that the trend probably is it sneaks up a little bit higher than that over time, simply because that you just need that amount of barrels, the cost per barrel, in order to keep the production going, continue to invest back in the industry. And so a lot of these companies, I like them because they have good dividends and they're also buying back stock and investing in the future too. So yeah, some opportunities in that space also.
All right. Yeah, to me, you don't have to share this, but to me, this sector, it smells a little familiar to me to the mining sector, a couple years ago, where it just felt like it was really being overlooked, and that its strategic value was substantially higher than what the market was giving it credit for. And I think the difference, at least with the oil and gas sector versus the mining sector a couple years ago, is that while you're waiting in those stocks, you at least get paid pretty generously in the oil and gas space.
Yeah, the cash flow, and just a little while ago, we own one company up here in Canada called Meg Energy, and now it's got taken out, unfortunately, at a price which we made money on it, but we thought it was being as a take under it, basically. But at one point, the free cash flow yields on these things were like 15-16%.
Wow.
And so they were in 5 or 6 years, they could buy back the whole business, and they were buying back stock. They had dividends. And paying down debt and so forth. In a matter of years, they could buy back the whole business and take it private. That's how high some of these free cash flow yields were. And some of them even reached up as high as 20% at one point. And you can't avoid business like that. You have to put some dollars into them. And I think Rick Rule said it very well at a conference I recently attended. And I think he's repeated this a number of times, and probably when you've interviewed him. And I appreciate Rick. He's great when it comes to the commodities. He says you buy what people hate. So if they hate the sector, that's when you buy. And I think that's a very quick and easy way to remember things. If people are really down in the sector and it's broadly despised, then you should be looking at that sector very intently for investment opportunities. It's probably a great spot to be harvesting some opportunities.
Okay, so another good sort of dollar cost average play for the next year plus.
Yeah, and again, we go back to the longer term trends. If you want to bury this and you say, okay, I believe in AI, I believe in data centers, I believe in digitization, I believe we're going to have robots in our houses and so forth, and you go through all of that, we need energy. And so nuclear, yeah, we own some Cameco, but that's going to take a while. It takes a long time to build nuclear facilities. And the fastest way to get that energy is fossil fuels, especially natural gas. And that's the way the market's moving. And so, again, look at those areas in terms of opportunities. Yeah.
Okay. Not that you have to have an opinion on this, but there was some discussion earlier on in the live chat here about Bitcoin. Do you and your team there at Rocklink have any Any strong opinions one way or the other on Bitcoin, especially looking into next year?
Yeah, and I know the Bitcoin question. It's almost like I'm too old to get excited about Bitcoin, but I still like things that are tangible, I can touch, that are real, and I have a difficult time getting overly excited about something that's completely digital like Bitcoin. Having said all that, I'm sympathetic to the cryptocurrencies. I don't like fiat currency. I don't trust fiat currency. That's why I'm a gold investor. And so, but from our perspective, I'd rather go into the gold, the silver, the precious metals. And if I'm going to tokenize anything, I like what Tether's doing by tokenizing the gold royalty companies and backing it by gold rather than by cryptocurrency. So I'm not a big fan of the cryptocurrencies. I'm not negative on them. We do have some clients that insist on owning some, and we put them, some of their portfolios. I'd say I'm sort of indifferent to it, and I just prefer to go where I understand the investment better, and I appreciate precious metals better. To me, Bitcoin and some of the other cryptocurrencies could go almost anywhere. What I think is incredibly valuable is the blockchain. It's the blockchain that's valuable. That's where, we look at tokenization, look at some of the companies that are involved there. If they were ever reasonable value, some of them are just trading at crazy prices like Circle and so on. We would step in and buy some of those, but right now they're just trading at too high valuations. But the blockchain is powerful. What trades on it, again, I just have a hard time valuing them and understanding how you put a true long-term value on stuff like Bitcoin or Ethereum and so forth. Yeah.
Okay. All right. I'll take one last question here from the audience, then we'll wrap things up here. Okay. Hey guys, a Romanian here. Do you think the global economic trend is moving towards a neo-medieval economy in the sense that we will have an owner class and a rentier class in the future? This is something, just to let you know, Jonathan, being totally transparent, something I've learned about a lot on this channel. We talk a lot about the K-shaped economy. My regular viewers here have told me, I think it's in danger of morphing into a lowercase I-shaped economy where, you have the haves, so the little dot elevated above everybody else by themselves, and then the majority is the stick below, getting increasingly left behind. I've even said it, America, if it hasn't already gotten there, is dangerously close to becoming an aristocracy where, it's true at this point in time, the number one predictor of your economic success in life is were you're born to wealthy parents or not at this point. The amount of assets that are held by the top 10%, especially the top 1%, and especially the top 0.1%, are just, it's a different stratosphere than everybody who's not in those cohorts. And sadly, that wealth gap still continues to widen. And, I know you were talking earlier about, the new administration talking about, hey, we want to do more for Main Street than for Wall Street. I hope that is their intent, and I hope that is the effect of their policies. But a lot of their policies still today, are business as usual that are driving asset prices higher. And as long as that happens, it is benefiting vastly disproportionately the minority that owns those assets, right? And everybody else is feeling further and further left behind. And, obviously, same in your country is same in mine, record levels of unaffordability of the basics, housing, education, et cetera. So sadly, I think the answer here is yeah, unless we really change things policy-wise, yeah, I think that's where we're headed. What are your thoughts?
Well, I agree 100%. I think, look, we'll say a few things that maybe aren't as politically correct, but the reality is that I think the global agenda, the Davos group, the Davos crowd, the World Economic Forum group I think, have been promoting policies for the last couple decades, that reward the few at the expense of the many. And they line the pockets of the super rich, and they build these, build these policies around really almost a cultural Marxism, which is what we've seen. And it's interesting that you were talking again with Matt Taibbi about increasing view of Marxism or communism in America. You see that through the mayor of New York and some of the young people just sort of throwing caution to the wind and saying, okay, free enterprises, and it's interesting. And so you've had this increasing sort of growth of electing people who are really very, very left. I mean, they're not just socialists; they're virtual Marxists, and that's a big concern. I think that is a byproduct, though, of exceptionally large government that's become overbearing over the last number of decades, and productivity going down, and then offshoring our manufacturing and so forth, and the squashing of standards of living for the average person, for the person on Main Street. And then you've had these attacks of, as they say, cultural Marxism, the DEI, the intersectionality, putting different colors of people against each other, creating racial division. I mean, it's just all of this stuff has created such disunity in our culture and our economy and our society. And then you've had the complete breakdown of the family unit and the attack on the traditional family unit. All of these things go to breaking down your class structure. And so in terms of the underclass becoming a permanent underclass in your economy. And so these are big issues, big concerns. I think the only way to reverse it we must go back to a faith-based economy. We have to go back to our strong Christian roots, which is what underpinned all of Western civilization, the whole biblical understanding of righteousness, justice, biblical law, and so forth. If we don't go back to that and then try to rebuild ourselves and break down all these power structures that have been created in our economy, then we will not have a strong, vibrant, free market. We will have one that's a neo-feudalistic one where just a few people control and they own all of the assets, and you'll own nothing and be happy type of thing. The only way to break that down is a complete reversal of what we've been doing the last number of decades. And again, I think that starts with personal faith convictions, strong faith convictions, that will then build up from there into the strong family unit, into building strong societies, weakening the size of the government, cutting the size of the state. The state is just way too large, too intrusive, and people have to take personal accountability and responsibility. And if you don't work, you don't eat. These are basic principles. If you try to get around those and you create a socialism and a stateism, it's only a matter of time before you have a complete class divide. And so the only way to break that down is to reverse all of these policies. And if we don't, I think the person that wrote that question is dead on. We are going to go into a neo-feudal situation.
All right. As you were talking, somebody said, cultural Marxism, Jonathan, look no further than the Canadian federal government. I don't think you disagree with that, right?
I agree 100%, absolutely, and 100%. And we saw that with the Biden regime also in the United States. Again, fortunately, Trump, again, is not perfect. I know he's got issues, but at least they're attempting to try to get that out of the system, where we evaluate people on their merit and on what they add to society. We try to treat people equally. We don't judge people by the color of their skin, but by the character, by their what they stand for, their virtues, who they are. If we don't go back to that, then we're going to let ourselves get attacked. That's what cultural Marxism does, right? It wants to build disunity and attack amongst the different groups in the society, and wants to pit everybody against each other. And we can't build if we're fighting each other. We can only build together and build a great economy when we're communicating, talking, have open dialogue, and we're working together, and we have respect for everybody.
Yeah, I can't agree more. This has been creeping into more and more of my recent interviews. This sort of it all comes down to values. Like what are the foundational values that we can all agree on, so that we're not demonizing each other, which is one of the ways society seems to be devolving right now, where we've broken into these factions where it's easy to demonize the other, and then that begins to give you what I call the sort of false justification for inhuman acts, and we're seeing more and more of people reacting to their differences with violence that I think most Americans or most Westerners would say, hey, that has no place at all in our society. So anyways, folks, I just mentioned this because, if you'd like me to try to do a few more interviews in 2026, trying to really get to the root of like, well, what are the values that we should all be uniting around to try to either build a better economy or build a better society. That's something I'm open to doing if there's demand here amongst the audience. All right. Oh, sorry, Jonathan.
And I was just going to say, those are all interrelated. So I think I would encourage you to go down that path, Adam, because you can't build a strong, vibrant economy unless people are working together, unless they share a common ideology and common views, unless there's a common base upon which you're operating on. You have to have a rule of law and so forth. So when you start talking a little bit about the political area, it's not just politics, that's our economics too, because if you don't have stability in your economy, people are not going to be investing capital over the long term. So if you go down to, the best place to go is just down, say, South America, and you can look at the ups and downs down there in governments. You don't get this consistent investment of capital, which drives a compounding GDP over time. And so it's critical that we are politically stable and we have free speech and people can communicate to each other and we can hold government accountable, because whenever they step on free speech, this is why your First Amendment is powerful. And it's turning out in the world that one of the only countries left where there's a relatively large amount of free speech is the United States, because you've got the First Amendment. In Canada, we're seeing legislation being passed just as I'm speaking right now called C9, which is going to, again, limit our speech in our own country. But if you don't have free speech, a lot of times the reason the government's clamping down on that is they don't want you to expose what's going on in government. But if we can't expose what's going on in government and their spending and their policies and how they're driving the economy, taxation, all of this sort of stuff, it will also spill over to the economic front. It's unavoidable. So these are all interlinked. And so I think it's a topic that investors should be more concerned about, what's going on in the political area, because it will impact their pocketbooks. Don't fool yourself. If you don't, everything's been so stable in North America and many of the Western countries for many years, we just assume that that's what it's going to continue. But don't make that assumption. There's a lot of changes going on. We need to protect our political systems and our democracies and our freedoms, and especially freedom of speech and freedom of religion within our countries.
Well, again, very, very well said, Jonathan. And for those that are familiar with concepts like the fourth turning, you were saying, Jonathan, look, we need to basically reverse a lot of the policies that a lot of Western countries have been going down. The fourth turning, the concept is that's where the status quo is kind of dismantled, it breaks down, it's then replaced with something. And it's not, again, it's like a season, it's like winter. It is a healthy cycle to a certain extent. But you can't be just for tearing down, right? You've got to get into the first turning again, the next first turning, you have to determine what you're for, right? So, I want to make sure that we're doing our part, not just to point out the things that are wrong, but to start advocating for the things that are better models to replace what we have right now. All right. Well, as we wrap things up here, Jonathan, thank you for, again, making time to do this with us on Christmas Eve day. I'm sorry if I've been a little slow-witted during this conversation, doing my best just to fight through the fog inside my brain here with this darn cold. For folks that are hoping to get 2026 off to a good start, and in particular folks that live in Canada, and would like to get some help from a good professional financial advisor, can you just talk for a second about if they just called you up and said, hey, Jonathan was listening to you on Thoughtful Money, really like how you guys think. If they reach out to you, and I'll tell them how to do that in just a second, what would the experience feel like with your team from first call?
Yeah, and we love people to contact us. We've had quite a large number of listeners contact us from Thoughtful Money, so that happens on a regular basis. And we take the call, talk to you, explain a little bit more about what we're doing. There's no pressure whatsoever from our perspective, and we will then look at your own portfolios and give you an analysis of where you now are positioned and whether you're comfortable with that, where we would make changes, where we see opportunities going forward, and just work with the client to know them, understand their risk tolerances, and how we can create an individualized portfolio for them that meets their long-term needs. It's very easy. Of course, when you're in the country within Canada, if someone wants to, if they have assets at a financial institution, those are easily transferred over to another institution. We are registered right across the country, all 10 provinces, and would love to hear from anyone that is interested in just having a quick review of their portfolio, see where you stand and whether you're well positioned for 2026.
All right. Well, two things, folks. First, please join me in thanking Jonathan for coming on again by hitting the like button. And then if you haven't already, clicking on the subscribe button below, as well as that little bell icon right next to it. And if you live in Canada and would like to talk to Jonathan and his team there at Rocklink, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds. Be sure to say that you're a Canadian and you'll be matched with Jonathan and his team there. If you're an American and watching this, just fill out the same form, tell us where you live, and we'll match you with one of the other financial advisors that Thoughtful Money endorses that are US based. And these are the firms you see with me on this channel week in and week out. They'd be happy to help you as well. Jonathan, very much appreciate you doing this. Great discussion. I'm really enjoying seeing people saying in the comments here, wishing you and me kind Christmas wishes, which is wonderful. But some people saying, hey, this was a really good interview. And that's great because I am so cotton brained. I really had no clue how this video is going. So I'm glad I did.
Yeah. The flu bug that's been going around has just been really severe. It just seems to hang around a long time. So praying that you get over it quickly, Adam, and doesn't interfere too much with your Christmas celebrations with family.
Thank you. Thank you. I'm on day 4. I'm going to bet that I'm turning the corner later today or tomorrow, hopefully.
You have to come down to the Cayman and get some vitamin D naturally.
Yeah, well, be careful what you wish for. I might be there tomorrow, buddy. All right. Well, look, thanks so much, Jonathan, and everybody else. Thanks so much for watching.
Okay. We're likely going quite a bit higher on gold from here. And the fact is it's just the basis of the government is going to continue to spend. The Fed is continue to do what they've loved doing for ages at this point, which is printing money essentially and flooding the system in any downturns. And that is going to fuel gold higher. I would not be shocked to see 3,800. Now, that's not the cycle top, but I think 3,800 is likely your upside parallel trend line of resistance. So I think by year end, 3,800. And then I think you're talking in the next couple years well over 5,000. And silver, we know, has lagged gold. I do think it's in the process of playing catch up. Basically, I'm expecting it to have a small stop at $44 per ounce, but really likely headed to about 48 to 50.
Gold is anticipated to increase in value as long as the Fed and government continue to generate money. It may hit $3,800 by the end of the year, and in the upcoming years, it may surpass $5,000. The Central Bank of Poland, NBP, is taking steps to raise the percentage of gold in its overall reserve assets from the present level of roughly 22% to 30%. Poland is already one of the world's most active gold buyers in 2025. It reflects a strategic shift toward de-dollarization and lessens dependency on the US dollar by increasing gold reserves. Although it might see a decline after reaching that level, silver, which has trailed behind gold, is expected to increase toward $48 to $50 an ounce. Gareth Soloway, a seasoned trader and technical analyst, points out that gold is expected to stay well supported, unlikely to drop below $3,400 to $3,300, and could reach about $3,800 by year-end. UBS raised its end 2025 gold target to $3,800, citing anticipated Fed rate cuts, a weakening dollar, and rising geopolitical risk. Countries like Poland and China are boosting gold reserves, showing a steady move toward de-dollarization. China has expanded its gold reserves for 10 consecutive months, reaching 74 million ounces by August 2025, about 7.6% of its FX reserves, while also streamlining gold import rules to ease trade. Poland remains a leading buyer, adding 12 tons in early 2025, surpassing the ECB's holdings. Analysts see both moves as part of a wider de-dollarization trend, with surveys showing more central banks planning to boost gold reserves as a hedge against dollar volatility. Gareth believes this process won't happen overnight but will gradually weaken the dollar. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I have a hard time believing gold would pull back lower than, let's say, 34 to 3,300. There's just way too much support now in this chart, in this zone, that as long as it holds there, you're buying it, at that pullback level. And that's exactly what I plan to do. So again, yes, in the near term, I'm a little like, again, if you say, well, where do you see gold in the next 2 weeks? I think gold comes down. I think it pulls back, natural occurrence. But if you ask me in 6 months, is gold higher? I do think gold is higher. Now, a lot of people are always asking, okay, well, what's your upside cycle target? Well, where could this go in the interim for upside? And I think to do that, what you do is you use what we like to do in the technical world is you use essentially a parallel channel, right? And we start to look at parallels here. And I would say by end of this year, I would not be shocked to see 3,800. Now, that's not the cycle top, but I think 3,800 is likely your upside parallel trend line of resistance. So I think by year end, 3,800. And then I think you're talking in the next couple years well over 5,000. I think Goldman is pretty much dead on at this point. I love what you mentioned about these countries. Poland just announced again 30% of their treasury is going to be gold. I think the important thing is that we're slowly seeing this de-dollarization. And again, when people talk de-dollarization, especially in the crypto markets, they're like, oh, it's going to happen overnight. Reserve currencies, if you look historically, that never happens. It's a longer process, but we're seeing the writing on the wall. China just continues to buy gold. Poland now is going to do a portion. And essentially what they're telling you is that they don't feel comfortable with the power that the U.S. wields because they have to rely so much on the dollar. And so they're slowly diversifying away, which will slowly weaken the dollar over time. And in fact, the dollar chart is telling us exactly that. In fact, I want to go over this chart because the DXY chart is really, really telling. So if we go to the dollar chart here, what we've seen is a key breakdown in the US dollar here, and I'm going to just draw this in for you guys. So there was this trend line zone that was holding on the US dollar for the last basically 2 to 3 years. And you can see again, going back to 2022, we would hit, and every time we hit, we would bounce on the dollar. All of a sudden, we broke below. Now it becomes resistance. Remember, support, once support breaks, it becomes resistance. And now up it goes, rejected. Up it goes, rejected. Now the concern I have here on the US dollar is if we flip to a longer time frame and we go back to 2008. And by the way, 2008 is not an arbitrary date. It is when the financial crisis started. And so if we take a trend line from there and we drag it up, the dollar has a very distinctive trend line that basically goes from 2008 all the way to the current lows. My point being, if the dollar breaks this level around 96 to 95, that would be a major technical chart breakdown. And I would say, listen, again, I want to be clear. It doesn't mean it's going to collapse overnight, but I would actually think the dollar would head within the next, let's say, 5 years down to 70 on the DXY. And 70, I mean, that would be shocking to see for all of us.
Gareth highlights that gold and stocks have both been hitting new highs, but history suggests this won't last. Gold is likely to hold up better thanks to dollar weakness, central bank buying, and investor demand, while the stock market could eventually give way. Silver has broken out of a long wedge pattern and is catching up to gold, with potential to reach $48 to $50 per ounce before facing strong resistance. If it consolidates at that level, it could set up for a bigger move higher, but a sharp reversal would be bearish. On the macro side, silver is supported by rising demand from industries like combustion engines and by sovereign funds diversifying beyond gold to avoid over-reliance on a single asset. Let's recall the interview.
Yeah, so I think the big macro signal is this, right, is you have two scenarios. So number one, the stock market and gold have been making new all-time highs consistently together. That does not last. If you look historically, it can last for short periods of time, but it's telling you one of them is not going to last. And in this case, I believe gold, yeah, while it might have small pullbacks, gold is going to be the one that is going to outlast, whether it's weakness in the dollar, whether it's the labor market and people running for the safety, whether it's global central banks that continue to buy gold, or these countries that are going to continue to buy gold. Gold is becoming that place to go, along with Bitcoin to a much lesser extent, where money is flowing. And again, if that's going in that direction, that's not good for the stock market overall. So that's a big one that I'm following. And again, keep this in mind. Watch for a break of trend from either gold or the dollar, gold or the market. And I do think the stock market will give way as the data continues to weaken here. You to like silver here. You can see you had this beautiful wedge pattern right here. And again, this wedge pattern, look at this trend line, how every time going back to 2023, every time it hit, it pulled back, pulled back, pulled back, pulled back, and then pulled back recently in 2025 twice. And then what it does is it gaps above. It's like, okay, I can't walk through this river because it's the rushing river will take me away. So let me hop over. Let me take the bridge over. And all of a sudden it breaks out, consolidates. This is a bull flag, and it's beginning to move higher. So this is a breakout on silver. And silver we know has lagged gold. I do think it's playing in the process of playing catch up. Basically, I'm expecting it to have a small stop at $44 per ounce, but really likely headed to about 48 to 50, which would then, if we go to the bigger time frame, 48 to 50, where does that take us? Back to this high here, 1980 and the 2011 highs. Essentially, that would be called a triple top, and that would be expected to be resistance. Yeah, so you basically look to sell it to $48 to $50. So if silver gets to 48 to 50, I would expect it to pull back. Now, it could eventually break out, and that's what I would start to watch. And let me just do a quick teaching on this. So if you have silver, right, and silver, let's say, rips up to 48 to 50. Let me get my drawing tool out here. So let's say we rally up here. You then watch, as a technician, you watch to see what it does off of this level. What you want it to do is basically go sideways to lower, which creates a bull flag. It's essentially digesting. Think of a marathon runner who just ran a marathon. They're exhausted. You can't be like, go run another marathon. They're going to be like, no way, I need to refuel, I need to sleep, I need to rest, I need to eat. This is what this is. It's consolidating, it's refueling, and then you get your big move up. What you don't want to see is you don't want to see a sharp reversal. A sharp reversal would be bearish. So as a technician, if let's say we get to $48 to $50 an ounce on silver, I will then begin watching what price does around that level, and that will give me insight into the next likely move. You know, silver is going to be seen as obviously the macro, driver of combustion engines, which are now becoming more and more popular again after the EV kind of had its phase. And I still think EVs are in that direction, and they will continue to grow, but not nearly as much as people thought. And so I think you have that aspect to it. But I also think that you're looking at, there's these sovereign funds in these countries that are saying, okay, gold has had this massive run, and just like the dollar, we don't want to just be in one metal. Like, what if something happens and there's a massive find of gold? Let's diversify. And I think, again, what's so interesting here is that these countries are learning from their mistake with accepting the dollar as the major reserve currency, where it gives the U.S. way too much power. They are not comfortable with that.
With long-term goals above $5,000, gold is still on a solid upward trajectory bolstered by Fed policies. The robust gold purchases by China and Poland point to a larger trend toward de-dollarization, whereas silver, albeit trailing, has the potential to make large gains if it can maintain momentum. Although the dollar's collapse will be slow, Gareth Soloway emphasizes that these tendencies indicate a shifting financial landscape. Will the increase continue to be steady, or may central bank gold purchases accelerate prices even more toward $5,000? Will silver risk a steep reversal or consolidate for another breakthrough if it encounters resistance at $50? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and we thank you for being with us.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And I our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200. Would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LB delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200. Would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record, speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And it wouldn't surprise me. And then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. What happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher.
Confidence in the dollar is fading, pushing investors toward gold and silver with their 5,000-year track record. Goldman Sachs says if just 1% of Treasury money shifts, gold could hit $5,000, and some estimates go as high as $9,000. If gold reaches $5,000, as some forecast, silver could climb anywhere from $55 to $350, pointing to much higher prices ahead. Andy Schectman, the president and CEO of Miles Franklin Precious Metals, points out that, similar to central banks, people might profit by diversifying into gold and silver as currencies decline. According to Goldman Sachs, if even 1% of U.S. Treasury funds move, gold might hit between $4,500 and $5,000 next year. In the meantime, the concerning job data indicate that full-time employment is declining, part-time and multiple job holders are increasing, and about 1 million jobs have probably been revised downward. Future rate reduction will cause margins to further shrink, making smaller regional banks particularly susceptible. As we play snippets from the video, please hit the bell to receive quick alerts whenever we post a new video, like this video, and subscribe to our channel. I appreciate your support. Have fun watching the video.
Pick used to say all currencies, fiat, are inherently meant to die. In essence, it could go to infinity. Now, I'm not saying that's going to happen, obviously, but, I just think that people could benefit from diversifying more heavily into gold and silver, like the central banks have. Goldman Sachs sees the scope for prices to move well beyond 4,000 as their baseline forecast for next year. And even beyond the 4,500 tail risk scenario. This is, again, no public participation, but if 1% puts their money in of privately owned U.S. treasuries, they're saying 5,000 an ounce. So I don't know. But I just want to hammer it home. If Trump lowers yields by 2 or 3% real yields, it'll be negative. Even by their numbers, big money will not stand for that. That's why they are front-running this. The world's largest players, the central banks, the global lenders, the corporations, the global lenders being the commercial banks, the ultra-wealthy, they've all been quietly repositioning. But once it becomes obvious that the public will realize that fiat money is eroding, is it too late at that point? I don't know. I'll leave that up to everyone else. A couple last things here. The jobs report. The consensus was that between 40 and 100,000 jobs would largely green light a 25 basis point rate cut. But we would need a massive, massive outlier for the Fed to cut by 50 basis points. Well, we got that outlier. The BLS reported that in August we only added 22,000 jobs, not the 79,000 jobs that were expected. But more importantly, June was revised from 27,000 to negative 13,000. It's the first negative print since 2020. They keep revising these jobs numbers. Remember what happened with July and August, those numbers. To the ugliest part, in my opinion, of the jobs report was the number of full-time jobs. They fell by 357,000 jobs. That's the second consecutive month of full-time job losses, while part-time jobs surged by 597,000. So you lost 357,000 full-time benefit-paying jobs, and you added 597,000 part-time. Kind of seems like people are working 2 or 3 jobs to make ends meet. It gets worse. The number of native-born workers fell by 561,000 to 132.474 million. This was the biggest drop in quite some time. At the same time, foreign-born workers increased by 50,000. The number of multiple job holders soared by over 443,000 to 8.785 million. This was the biggest monthly increase since COVID. And another indication of how stupid the jobs report in the Bureau of Labor Statistics. We should just pull the L out of it, and it should be called the BS. They continue to do this stuff. Now, next week, I think, is it next week? I think it is. They are supposed to revise job growth figures from early 2024 through early 2025. Forecasters have thought that job growth would be slower than previously thought. Now you're getting analysts saying revisions anywhere from 475,000 to 1 million jobs will be revised out. Originally the number was 1.76 million. They're talking about revising 1 million out of the 1.76. I think, let's see, I got maybe 2 or 3 more things left to say. I found it interesting that Trump says that the United States has lost India and Russia to China. And he said, may they have a long and prosperous future together. That's what he came out and said that. And maybe that's because both India and China confirmed to boost their ties to reduce the effect of Trump tariffs at the Shanghai Cooperation meeting. We're seeing insured deposits shrink out of the banks. In particular, the regional banks and the small banks, and a lot of money is finding competition with digital banks and stable coins. And wait till you see what happens with all these stable coins, with fintechs and stable coins offering higher yields and lower fees and instant transfers because they don't have brick and mortar, and they don't have ATMs and all this stuff. We're not out of the woods yet with the banks, and the more we start moving towards this digital system of stable coins, you're going to massively erode the stickiness of bank deposits, and which has been the foundation of bank stability. If the Fed cuts rates, banks are going to earn less from lending but still need to pay competitive deposit rates, which squeezes the margins and makes the weaker regional banks more vulnerable.
Andy Scheckman highlights that with significant institutional and individual orders as well as historic ETF inflows, there is a massive stockpiling of silver. Saudi Arabia and other major players may still demand supply even though SLV raises questions about manipulation. BlackRock has even cautioned that a short squeeze brought on by silver shortages might drive prices skyrocketing. Silver should already be far higher given the current price of gold. At historical ratios, it might be between $90 and $100 per ounce, and in the worst cases, it could even be $500 or more. Now let's redirect our attention towards the interview.
You're seeing the numbers in all of vaults except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But seven-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving. And the numbers, the eligible numbers are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote very possibly that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to really to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately, that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure.
A critical period for both gold and silver seems to be approaching, driven by mounting supply restrictions, central bank buildup, and waning dollar confidence. The outlook indicates that both metals may see significantly higher prices in the future because of the big positions taken by institutional and sovereign purchasers, as well as the possibility of a silver short squeeze. How soon might gold and silver hit these anticipated levels if central banks keep moving away from the dollar? Would a silver short squeeze primarily help long-term holders of actual silver, or could it cause more widespread financial market instability? In the space provided for comments below, express your opinions about Andy's insight. Please think about sponsoring us and putting on notifications if you think this video is educational so you can see our most recent videos. See you in the video that follows. I appreciate you viewing.